All right, no worries.
No worries, nice one. Okay then, all right. Hey everyone, how's it going? Welcome back to Value Investing Unleashed.
Yeah.
So yeah, we've got various topics to chat about today. So yeah, where shall we start off, mate?
Want to talk about Walgreens? Let's talk about Walgreens first.
Yeah, sure, yeah.
Okay.
Walgreens Boots Alliance.
hmm
So what do you want to know?
Okay, so tell me what Walgreens is about first. Tell everyone what they're about. What do they do?
Yeah, sure. So Walgreens Boots Alliance. So the main part of the business is Walgreens, and it makes up like I think it's way over 80% of the sales of the business. Essentially, it's a pharmacy chain. So
hmm
Walgreens is in America,
hmm
pharmacy chain. Also, if you go into Walgreens, you can buy, sweets. It's like going into Boots in the UK, but
Yeah.
basically Walgreens is Boots, but in the US. Um, the company itself came together. So Walgreens Boots Alliance basically came
Yeah.
together. Trying to think when. I think it was like, should know this from the video. I'll just pull it up.
Okay.
Yeah, it was like in 2012. Walgreens purchased the Boots Alliance shares, and then I think it's like 2014 they had
Yeah.
the full takeover of the business. So basically, both the businesses, the pharmacy chains, and yeah, they're just pharmacies. People go get the prescriptions, they go in to get a few bits and bobs, but it's a pretty simple thing to understand, really. Pharmacies are
Yeah.
always going to be needed. And yeah, so that's a little bit,
Yeah.
that's probably very basic about the business.
Would you class Walgreens as a retailer or a pharmaceutical like company? Because a lot of people say it's retail, a lot of people say it's pharmacy, like healthcare. What would you class it as?
Yeah, that's a good question. I would, I'm going to sit on the fence and say it's 50-50,
Mm-hmm.
because my personal take on retail would be something like a Foot Locker, or
Mm-hmm.
in the UK, a Debenhams, something where it's just straight up selling like a clothes shop or something. But
Yeah.
the pharmacy element makes it a little bit different in some ways, but there's the argument for but it is a retail business. I wouldn't argue against anyone for saying that. The
Mm-hmm.
margins probably do show it's probably a retail business.
Mm-hmm.
So yeah, probably say retail then.
Yeah.
Go with it.
What about you, Logan? Have you heard about Walgreens or dug in it deeper into it?
Yeah, a while back I did a Walgreens and CVS comparison. Yeah, I don't love them, but between the two, I definitely go with CVS.
Mm.
I would probably classify them as retail business.
Yeah. So what do you like about CVS? Because there's always that comparison between the two, isn't there? So what's why is CVS better for you when you compare it to Walgreens?
Gotcha. Yeah, so I pulled up a post a while back, just looking at it. They've got like a similar valuation,
Yeah.
about an 18 PE,
Mm-hmm.
but the CVS is actually growing. Walgreens is still stagnant and not really growing at all. CVS has better margins. I'm looking at Walgreens. When I did this, I had 2% net margin. CVS had 2.5.
Mm-hmm.
So they're pretty tight, which kind of shows that it's a retail business. But yeah, I would definitely go with CVS.
Okay. Yeah, and I noticed there's a lot of high like depth between both these companies. They have huge like depth, so it's kind of normal in this sector, isn't there? Like where there's a lot of like depth compared to the assets. So yeah. But I think I prefer Walgreens. I don't know. Maybe I have to look more into CVS to. Well, for me, it's Walgreens at the minute. Are you invested in CVS by any chance?
No,
No.
I don't love either of them. It was just like between the two, I would go with CVS. But yeah, neither of them are really my favorite.
Yeah. I mean, for me, like Walgreens is a good company to have in your portfolio. I mean, it's a boring company. Like it doesn't do much, does it? Pays a good dividend, so yeah. So, all right, then you got any numbers that we could look at, Lewis, like in terms of like its fundamentals?
Yeah, so I did a video on Walgreens, and that's one reason we're chatting about it. And I
Mm-hmm.
mean, I think the reason me and Wes are quite attracted to it is because of the low valuation of it.
Mm-hmm.
Like, even with really, really low growth rates at current valuations, if they can maintain the revenue, even if it didn't grow,
Mm-hmm.
it's looking like a decent buy based on the valuation. And if they can just grow with inflation, the revenue, then you'd be onto a winner.
Mm-hmm.
Something that did concern me a little bit when looking at it was over the past couple of years, the margins did tail off a bit.
Yeah.
And okay, maybe you can give them benefit of the doubt with COVID, but you don't want that to continue. You don't want that sliding margins going down and down. You want it to obviously get back to where it was. But yeah, I wasn't too concerned about the debt when I was having a look at it. The long-term debt to equity was 24.4%,
Mm-hmm.
and I personally like to see below 50%.
Yeah.
But I haven't looked at the everything money screen. Let's look at what the free cash flow.
Mm-hmm.
What's it called again? What's the pillar where the free cash flow gets compared to the debt?
Oh, that's price to free cash flow over long-term liabilities, is it?
Yeah, so it's to see if the 5-year free cash flow can cover all the debt. So it'd be interesting to see what that figure was. And I don't think it's too bad, to be totally honest. It's reasonable anyway. It's not like it's mentally high. So yeah, I was okay with the debt. The margins are low for a business that I personally want to look at, but I like the consistency.
Yeah.
The consistency is because I prefer higher margin businesses from any sector really. But yeah, the net profit margin is, it's for retail business, it's quite low. But as long as it can stay consistent, that's what I like to see. And something they are doing is decreasing shares.
Yeah.
They've decreased a lot of shares over the past 5 years. They've
Mm-hmm.
actually been repaying some of the long-term debt as well, which is awesome.
Yeah.
So yeah,
Pretty solid dividend as well.
Mm-hmm.
shows that they can allocate capital pretty well if they're repaying debt, buying back shares, and keeping that dividend. Yeah, I think that's first. I think it's not doing too bad.
Yeah, it's a simple business, really, nothing too complicated, which is what I like in a business, the simple ones. And have you got like the price you want to pay for the company in terms of your assumptions?
Yeah, sure. So I'll just get my valuation up. Yeah, so for 10% return, my required rate of return, so that's the discount rate of 10%. I'm looking at a share price of $66 per share. And this is with free cash flow numbers not growing that much at all. So 2021, we're looking at 4.4 billion, then 4.6, and then 4.5. So that's for the next 3 years. So you're talking about minute growth, if not any. So that's what the valuation is. What's attracted me quite a lot to it, because even if the free cash flow doesn't have to grow much, there's still a value to that. So that's the way I kind of see Walgreens.
Yeah. Okay.
But what exit multiple did you use?
Yeah, my DCF doesn't actually have an exit multiple on it, which is. So I'll have a look at what the exit multiple probably is. But I'd always want an exit. It depends on the growth rate, of course, but I like the 100-year market average, so let's say 16 or below. So I'd actually prefer below that, because to be conservative, and I think Walgreens, terminal multiple below 16, the 100-year market average, that's probably a fair figure to use.
I think I used 12 for my exit multiple, because you
can't complain with that. That's conservative, but that's conservative for sure. But you can't complain with that. It helps you as an investor if you're more conservative.
Yeah, and I think I got to a buy price of $45 a share. So
okay,
for 15% return. I mean, it's a pretty good buy at this price now. I think it's at 50. It's a pretty good buy now. You won't that nothing's gonna happen, but have a pretty high discount rate. You probably still get around 12% buying it at the current price now. Okay, anything else on Walgreens?
No.
Yeah, I don't think there's much else to say really. It's a pretty boring business, but
Yeah,
it's pretty boring.
flashy.
It's not a flashy tech business, is it? It's just a pharmacy chain / retail chain. Most of the businesses in America, I think 10% or less is in the UK or basically outside of America. There's not much else to say really. It's a good valuation. Yeah, I think it's worth a look for everyone. If you're a value investor looking for a stock, it's something to look into. And CVS as well. The reason I didn't go for CVS is because of the insurance part of the business. I don't really understand it. But yeah, if that's something you want to get into, then have a look at CVS as well. There might be 2 good options out there.
Yeah, definitely. So let's talk about like commodities. Anyone here invest in like commodities? I know you do. Logan, you love it.
Yeah, I got a little bit.
Yeah. So what have you got?
I've got an ETF for agricultural commodities. That's more of a play on fertilizer prices. Usually fertilizer prices go up, and then the commodity follows.
Yeah.
Fertilizer prices are sky high right now. I've got an energy ETF. I guess you can kind of consider that a commodity because it's basically tied to the price of oil. And that's really my main commodity plays.
Okay, so how are those commodities doing for you so far since you've bought them?
I think about an 8% return in the last month. A lot better than the market. A lot better than
Oh yeah, definitely. That's pretty good. It's definitely pushing your portfolio up, isn't it?
Yeah, it's keeping it from going down too much.
Yeah. I think it's good to have these sort of things in your portfolio if you can find the right, opportunities. What about you, Lewis? Have you got any commodities?
Yeah, so I have two. I do have a commodities ETF actually as well, but it's basically the full basket of commodities. As part of like my inflation, I call it my inflation part of my portfolio. I have a gold ETF, I have my commodities ETF. But yeah, in terms of stocks, I've got 2 main ones. So I've got Rio Tinto. So it's one of the biggest mining companies in the world. The company itself is actually Australian, but it's listed in the UK, the US, and Australia. So it's got 3 separate listings, but you can buy it on any of them exchanges. Yeah, what can I say? It predominantly mines iron ore, and it's got mines all over the world, but it also mines copper, rare earth elements, all sorts of kind of stuff. And yeah, it has low debt, pretty high profit margins, good capital allocation in terms of a solid dividend. But yeah, what I like about it is that in the current inflation environment, I think inflation's going to be here for a little while. Maybe not massive in terms of people think it's going to be hyperinflation, but we might see 4, 5, 6% inflation yearly for a while. And I think that'll mean commodity prices will keep at a certain level, and that'll help them businesses. And if you can own the lowest cost producers in these, be it mining, oil, then you should be on to winner, hopefully. But yeah, the other one is Equinor. So Equinor is the Norwegian, basically it's a state oil company. So I don't know if you know, but Norway has a massive pension fund, like a state pension fund. It's worth, well, I say pension fund, it's a sovereign wealth fund. So like in the 60s, in Norway, they discovered oil, and Equinor is owned by, I think it's about 66% of the Norwegian government. But basically, all the dividends went into a big pot, and that became the sovereign wealth fund. It's worth way over $1 trillion. So anyway, Equinor can take oil out the ground for $30 per barrel. If you look at the current oil price, that's quite good. So the lowest cost producers of oil is obviously Saudi Arabia. They can get out the ground very, very cheap, among some other countries. But Equinor, it's a solid business. I personally don't think oil's going anywhere for a long time. I think in the news and in the media, and maybe in the investing media as well, you see NBC's the push for, I won't say it's a green agenda, but it's like, it's just very good. It's good news. You know, it's easy to sell. Let's say if you have a green battery ETF, or what you call it? They call it greenwashing. So they'll brand an ETF as green and low carbon, but in fact, all they've really done is picked a few companies, added some extra fees onto this ETF. So a lot of that does happen, but you can't deny that oil at the minute is looking quite good. So if you manage to buy in 2020 at the low prices and you hold it for the long term, then yeah, it might be good.
Totally agree.
Yeah. So what if no one has all these commodities in their portfolio? Should they be looking to get involved? Like, because with inflation and stuff like that, should someone have these sort of stuff in their portfolio or not? Like, is it a recommended thing? Because I don't have any commodities at the minute. So is it something I should look into?
I mean, I would think so. Just even if it's just a very general, broad commodity ETF, it doesn't really take a lot of research. You know, get a basket with basically every single commodity in there, and it's pretty safe. You know, relatively low risk, but should be good with inflation.
Okay. What about you, Lewis? What are your thoughts? Is it something that I should look into, like getting some sort of commodity in my portfolio?
I'd say it's definitely worth looking into, and I'd say it's, you know, definitely worth researching. With commodities, you've always got that extra element of, you've not just got the business to worry about, you've got the commodity price. Be it if you invest in gold miner, you've got to worry about the gold price being a certain price, because that's how it's got to be at a certain level for them to make money. And it goes for all of them. But generally, if the business is good enough quality, be it oil, be it mining, then I'm happy to invest in it personally. But if you want exposure via an ETF, then go for it. Why not? If it's something you're interested in, I've done that with emerging markets. Like part of my portfolio, I'm looking to have 20% in emerging markets, but I'm not confident enough to go stock picking in those regions. So I'd rather have a general basket of emerging markets in my portfolio going forward, and my thought is over the long term that'll hopefully do well. And that's how I invest in emerging markets. But there's ways of doing it differently, and if commodities isn't in your circle of competence, then maybe try learning about it. But if you don't want to, you don't have to. There's businesses I don't look at, like car manufacturers is the one I will never touch them.
Even if it's at an attractive valuation?
Yeah, sure, yeah. I think in 2020 I saw Ford. It was a really low PE, but I don't want to. So I don't have to. No one forcing you to invest in a certain investment or stock. I've got a list of a few I just don't really like. I think that's fair enough. And yeah, no one can. It's up to you at the end of the day, isn't it? So
yeah. So how well has these commodities done for you then? What returns have you been getting since buying all these? Lewis, what returns have you been getting with the commodities that you've bought?
So Equinor and Rio Tinto have, been done pretty well. That's simply, it's not down to me being a genius. It's down to because the commodity prices have gone up.
Yeah.
I'm not going to take all the credit for it because over the past 18 months, anyone who's owned stocks has probably made money. So, actually, in the past year, unless you've owned the ARK ETF, then maybe you haven't. But that's a bit of a sore subject for some people. Equinor's doing pretty well, and Rio Tinto's doing pretty well. In the short term, I don't really like to talk about, I've made this return.
It's all about the long run.
It's a long term, yeah. Because what happens if tomorrow the iron ore price falls in half? Rio Tinto will probably fall in half. So Yeah.
Yeah, there's actually a quote. I think Jeff Bezos something. I can't remember word for word, but it's a pretty interesting quote where it says you shouldn't feel smart when something goes up by 30%, because if it goes down by 30%, you feel 30% dumber or something along those lines. But yeah, it's all about the long run.
At this point.
All right then. See you later.
No, it's Logan. Nice to speak to you.
Enjoy class. Yeah. Anything else on commodities that you want to touch on?
Yeah. From top of my head, I think it's a circle of competence thing. Some people
Mm-hmm.
will have a wider circle of competence. They're happy to invest in, some businesses and avoid some. Like I said, the car manufacturers is the number one for me. And there's a few others. Like I think I've spoken before about utility companies and telecommunication companies. I just think they have too much debt, so I just avoid.
Yeah.
That's just my decision. Like yourself, I know you said before we've spoken in the DMs about you don't like how the commodity price affects the business.
Yeah.
That's fair enough. There's nothing wrong with that. So you can't knock you.
Yeah, we all have different stuff that we like, and yeah. Let's see. Okay, let's So what's the way the market's going currently? Like, there's a lot of uncertainty with the whole Russia, with inflation. How does someone navigate this market in terms of like mentality? Like, should they have cash on the sideline to take advantage of opportunities? Like, what should they be doing?
Yeah, no, that's a great question.
Yeah.
You're making me sound like a CNBC analyst now, aren't you? Learn a process.
Yeah.
To start with, learn a process, whatever it is. If you're an index fund investor, for example, and you're putting money away each month, just keep what you're doing. Don't change what you're doing. You need to make sure you stick to your process. If you want to learn about value investing and going into individual stocks, there's a fair bit of work to do. Not in terms of, it's more mentally work to do. You know what I mean? I think you'd agree with that. Whereas mentally, mental in terms of learning, getting your mindset in the right place, learning about all the different things that make a company good or bad, red flags. Yeah, if you want to look at individual stocks, then learn a certain process and stick with it. Get yourself educated. YouTube and podcasts is how I've learned. I personally haven't done anything special. I haven't taken any investing classes. I haven't paid for any education. I've just absorbed knowledge over the past couple of years, and hopefully it'll pay off over the long term. I mean, made money in the short term, but I think judge me over decades, not years, because like over the past 18 months, everyone's made money in the stock market. Or if you haven't, then you're doing something wrong. So that's kind of the way. What about you? What do you think?
Yeah, I agree with everything you said. I mean, judge someone over a long period of time, and it's important to have a process because that process will help you during downtrends in markets. So yeah, definitely learn a process and stick to it no matter what. Don't like deviate away from it. And yeah, that's pretty much it really. And so I was gonna say something. I've lost it now. So yeah, so what kind of resources would you recommend someone to, like, if they want to get into individual stock picking? Like, where do they go? Because YouTube is pretty big. Like, there's a lot of
YouTube is a big place. YouTube is a big place, and I think there's three main channels which I watch religiously. So I watch all the time, and when I first started watching, because the first I started watching YouTube about like investing in stocks, and I was really fortunate that I managed to stumble across the right YouTube channels and not the hype channels, like Tom Nash, Meet Kevin's, what's he called, there's Andre Ajik, but he's not the worst one. Financial Education, Jeremy, and Meet Kevin are the two worst. They're just
The
awful.
tattoo chefs and Palanters and
They're gonna cause a lot people to lose a lot of money. I quite like Graham Stephan actually, and I think he's part of that quartet, that group, because it's financially benefits them all to be a group. But anyway, I'm getting off topic. Free YouTube channel. So Learn to Invest. Guy called Jimmy Coppell. He's been making videos since about 2017, or maybe before that, and that's how we'll learn about DCF valuations. How to value a stock. What does it all mean? Because it all just looks like funny numbers, which it kind of does, but he explains it really well. He's an American dude, and he goes through all sorts of stocks, and I watch him all the time. I've done for a good few years. And the next one will be Sven Carlin. He's probably the biggest value investing channel on YouTube, most likely. And he's a value investor. And what was his background? So he was a teacher at Amsterdam University, teaching business, and he's worked in the industry as well and stuff. And he explains things so well. Like, not just the numbers, but just the whole process of value investing. His ethos is fantastic. And he does a lot of research. That's what he mainly does, like investing research. And he just explains things really well. And that's what I really like about him. And he's someone I 100% recommend as well. And the final channel will be Everything Money. So we both watch them, don't we? And I started watching them about a year ago, actually. And their channel's blown up over the past year. They've gone from about probably a few thousand subscribers to now way over 100,000. So solid channel. Their process is fantastic. Their 8-pillar process is really, really good. And I've put some of that process into mine as well. So I like their videos a lot. If you don't like getting offended, don't watch them. But I think it's funny.
It is.
I've got a bit of a funny sense of humour, so I quite enjoy it really. I like it when they take the mickey out of people. But no, it's a great channel. So them three, you won't go far wrong. They've all got, like, if you want to learn about it, they'll have playlists on how to get started or whatever. And I'd probably say if you're wanting to get into stocks, just absorb as much as you can first. You don't have to just download your investing account and get at it straight away. Just try and absorb it, try and take it all in and just go from there.
Yeah, I agree. I actually watch all three as well through YouTube channels. So
amazing,
it's
nice
really
one.
good. Yes, that's what I mean. I made a post about this quite a while ago. Like, a lot of people say, like, you got to start investing straight away. I mean, it's important to invest, but you got to take your time as well, because a lot of people, they enter the market and then they rush into certain things like they don't know about, like the hype stocks and stuff like that.
Yeah, we start chasing returns. Chasing returns, and I mean, that's a natural thing to do, I guess. But if you just take a step back, just try and learn. If you've never done something before, they do say you do learn by doing. But when you invest in the stock market, you can lose a lot of money by doing that. So I think just trying to absorb as much, learn about a few different things. Yeah,
definitely. Start by learning about value investing. Read some value investing books. Ask questions with different value investors online, like Instagram pages, and just be around people with similar mindset, really, because they're the ones that will help you and stuff like that. But it's picking individual stocks is pretty hard, and you just have to remember, if you're gonna go down this route, it's gonna be hard, because your stock is not gonna go up overnight. Sometimes it takes a year, it takes a couple months, 3 years. You just have to be patient, really. But just take your time and don't rush into it, because the stock market's not gonna go away. It's gonna be there.
100%. Yeah, and when you're talking about that, there's a stock I've got in mind, which I've been invested in for a good while now. It's British American Tobacco.
Yeah.
So when did I invest in them? It was in 2020. It might be June 2020. I invested into them, or May 2020. But anyway, yeah. So I bought them, and their share price actually went down to about, I think, £24 per share. And now we've had some good earnings releases and stuff, and the shares are now at £34 per share. So I'm up a decent amount. And alongside that, I've received some pretty hefty dividends, like a good 8% dividend, and the shares have gone up. Like I say, I'm not saying I'm some sort of genius investing in British American Tobacco, but it just shows that if the market does turn, if the optimism turns into your favour with your certain stock picks, it can work out well for you. Like I mean, the sentiment with Facebook, Alibaba, Intel is suppressive. It's like for the worst companies to own, but then suddenly things can change really, really quickly, and that's you know what I'm saying, Wes?
Yeah, definitely. I completely agree. I mean, if you own companies like your Alibaba, your Intel, your Facebook, you look like an absolute idiot, don't you? Like, because why would you want to own a company that's just going down? So, what do you think? Like, do you think?
It's difficult. And it's something you got to learn. It's a skill you got to learn. Investing in, let's say, Alibaba and Facebook, probably two of the stocks we're the most probably excited about in terms of at the minute. That's probably fair to say. At current valuations and stuff. Yeah, when you buy it and that stock goes down, it's a horrible feeling. You're thinking to yourself, oh, what am I doing? Am I doing it wrong? Am I, I've got this wrong here? And your mind starts playing tricks with you. But you've just got to train yourself that the stock going down is actually a good thing for you. And that's when that clicks, it's a really good thing.
Yeah, that's something that that's clicked since I started value investing. That's something that I've trained myself. So if I bought a stock below its intrinsic value and it tanks like 50%, I've got to be okay with that because I know I'm getting a bigger margin of safety. So the downside risk is much less, and then my upside just take care of itself really whenever that happens.
Yeah, and it's something that Peter Lynch does say in his book, One Up on Wall Street. I put it up there. The mindset thing of when I can't remember the example, but he bought a stock and it went down, and I think he might have sold it. It might be early in his career, and when he sold it, it shot right back up. So yeah, you've got to be disciplined with your process. If you buy a stock below its what you think it's worth, you've just got to keep saying to yourself, keep invested or keep buying if you've got the cash to do so.
Someone asked a really good question. So, do you guys dollar cost average into the stock market, or do you guys put the whole amount at once?
Great question. That is a really good question.
Stock market, do you mean index fund or individual stocks? Because with individual stocks, I only dollar cost average if it's below the intrinsic value. So if it goes above it, I don't touch it because then I'm adding risk to my investment. So let's say I found a stock is valued at $100 a share and I added my discount rate, and let's say I need to buy it below $80. If I buy at $80, whatever the price is afterwards, if it goes to 70, 60, 50, I dollar cost average up and down. I never go above my buy price because then you're adding risk to your holding. So I never average up I never average up above what I bought it for, only average down. I mean, you must identify why it's going down first before you average down. You just don't average down and then you catching a falling knife really badly.
Yeah,
but I know a lot of people. I know a lot of people who average up. So they bought a stock at 70 and then it goes up to like 80. They average up again. I don't recommend that because you're adding more risk as it's go up. You want to average down and get that safety cushion. But with ETFs, you should be averaging every week, every month, because that's a completely different thing. And what was you going to say?
Yeah, I was just going to say I'll average up. The only time I'll average up is if I think
Mm,
the stock is still below its intrinsic value.
yeah.
So let's say,
Like Alibaba, because it's like I got an average price of, I mean, it's anything below 220 is a decent deal. So, and the stock's at like 120, so you can afford to average up a little bit on Alibaba because you're still getting that huge discount.
100%, 100%.
Mm. Yeah, it
So
all depends on the investment. Like if it's actual deep value, you can afford to average up a little bit. Uh, yeah. So yeah, what was we saying before that question? I said cool, thanks. Yeah.
yeah, what was we on about?
Oh yeah. Yeah. So when you're buying stocks, you want to buy the stocks that everyone hates because it's hard to make money in the stocks that everyone loves, and that's a hard thing to grasp because everyone wants that quick satisfaction of this company is going to go up quickly. That no one really wants to buy down because it's a scary feeling, and that's something you got to have built in inside your mind.
Yeah, 100%. And when Facebook dropped last week or the week before, whenever it was, first thing I did was just buy.
Yeah.
Literally,
Yeah.
I was just buying, literally.
Yeah.
And it isn't gonna. The mindset thing isn't gonna happen overnight. If you
Mm.
watch certain, watch certain channels, but consume certain content,
Mm.
and you surround yourself with people,
Mm.
surround yourself with people online,
Mm.
value investors, be it watching YouTube, listening to podcasts,
Mm.
watching this Instagram live, YouTube live, whatever.
Mm.
Just keep on watching these creators and investors, and
Mm.
just keep on learning about it all, and
Yeah.
the mindset will eventually click.
Mm. Yeah, I agree. For me, the way I learned about my mindset was just by watching Everything Money, listening to Charlie Munger, listening to Howard Marks, listening to Monish Pabrai, all these brilliant investors, Warren Buffett, and just imprint what they say to do into my head. And right now, I've said I'm there in terms of like, having the mindset to react to certain situation, but it does take a lot of work. It doesn't click overnight.
100%. Yeah, I think when we were first chatting, it clicked a lot quicker for you than it did for me. It took me quite a while, to be honest,
Yeah.
and it did take me quite a while. And I think when I felt it really started clicking when the COVID crash happened. That's when I really accelerated my learning in terms of, right, this crash happened, and it was a bit of a kick up the backside in some
Yeah.
ways for me. And like I was reading Intelligent Investor before that and everything, but it's like I understood it, but it didn't quite click
Yeah.
in some
Yeah.
ways. But it's continuously learning. And with some companies I've invested in, I look even a year ago and I look, why did I invest in that?
Yeah. I'm the same, to be honest.
And I look at it and I think, I didn't stick to a certain process, and now I've got this process which I'm pretty happy with, and I can discuss certain companies with other people, yourself, others,
Yeah.
and get different opinions, and yeah, so it's all a learning thing. So
Yeah, exactly. Like me, you, Logan, Crenshaw, we can actually discuss the same stocks and have different perspective because we all think like a similar way. And I think that's brilliant, really.
yeah, I remember 3M. So we were chatting about 3M a few weeks ago, and the stock is at a 52-week low at the minute. So it's looking like it's creeping down a bit,
Yeah,
and we'll see.
slowly. I noticed.
It's creeping down, and I'm rubbing my hands together. So we will see. But I remember, because of we value the stock slightly different because of our discount rate's been different, and maybe our growth rate's been slightly different as well.
Yeah, I think I put 3% and then 0 on the growth.
Yeah, and what did yours come out like? $110 per share or something?
Yeah, something like 110, 120, something around that
Yeah, and
mark.
I think mine's at like 140 or something. So it
Yeah,
just shows that even though I think we both like the company,
yeah,
we can still have a different price we're happy to buy it.
yeah,
So I think that's quite interesting.
yeah. And it doesn't mean he's wrong or I'm wrong. It's just
Mm.
how we see the company. Like I might be more conservative than him or something like that regarding that particular stock. So yeah, at the end of the day, we're both buying it for $1.50. So yeah,
And and the thing is, that's a good thing, because it'd be a bit weird if all investors had the same like price you'd want to buy something at.
yeah,
It would be a bit weird, and we all have different thought processes on some things.
mm,
There's some stocks where we can all look at it and be like, yeah, that's a screaming deal. Be it
yeah,
Alibaba at the minute and
mm,
Facebook, in my
mm,
view anyway, Facebook.
yeah,
And the negative sentiment around Facebook, it's when I see the negative sentiment, I love it. I look at the P
exactly.
ratio and I'm like, wow,
Yeah,
yeah, it happens all the time. Apple in 2016. If you have a look at, you can go on macro trends and have a look at the P ratio of the year or even the quarter, and you
mm,
can look. Apple got to a very low P ratio
mm,
because the market thought it was never going to grow again. It was going to
yeah,
actually decline.
mm,
Look what happened with Apple. I'm not
mm,
saying Facebook's Apple, but
yeah,
the market overreacts
mm,
sometimes.
mm,
Um, and it happens with a lot of companies. It's going to happen
mm,
with more companies, I think. There's
yeah,
companies on my list I'm interested in,
mm,
which, let's say Nike, for example. Nike is currently trading as if it's going to grow earnings at like 20% a year for the next 10 years.
mm,
But it's probably not, is it? Let's be honest.
yeah,
Like, great company, in my view, Nike. Just a bad valuation. It needs to drop a lot. It needs to drop a lot. It needs to drop to about $60 for me to be
I
interested as
think I
well.
have the same, like around the same, like 50, 60. It's a big fall.
Big fall. Can happen.
Yeah,
Can happen. So,
mm,
yeah, just give it time. Just got to be
yeah.
patient.
When you was talking about Apple, that was when Warren Buffett bought it, and he got a lot of criticism for it. Like, what is he doing? Like, he's lost his touch, and look what happened now. It's kind of
Warren Buffett, he's the greatest tech investor of all time, if you didn't
yeah,
know that.
yeah, yeah.
Warren
Um,
Buffett's investment in Apple is worth way over 100 billion now. I don't
mm,
know how much it is worth in the
mm,
latest filing, but
mm.
the amount of money he's made on Apple alone, it dwarfs anything he's ever done.
Yeah, I think
So
that was probably one of his great investments there.
I think what I like about Warren Buffett so much is when he sees an investment he really likes, he puts
Mm.
all his chips on the table,
Yeah, I
and
think you got to do that if you have
I
good
really like that.
conviction. Yeah, yeah.
And I don't think that's something I could do personally. I'd be
Mm,
happy investing in 20 solid companies at the right price,
mm,
but putting all your chips, that just shows how talented, but
mm,
how much of a genius he is, because he's
mm,
done it over a 50, 60-year period.
mm. Yeah,
Well, 60, more than that. Been doing it since he was like a teenager, hasn't he? So
yeah.
all you know, his book, he's got a biography called The Snowball, and then
Mm,
there's a book called The Warren Buffett Way, just his life from like 20s to now.
yeah.
The different stages:
Mm,
Geico,
mm,
American Express, Coca-Cola,
yeah.
and then the stuff he did. The financial crisis. He
Mm,
negotiated special terms with the American banks, and
mm,
he was essentially able to get shares in those banks at a ridiculously cheap price.
yeah.
Um, and then he bought the railway, and then he
Mm,
used the dividends from the railway to buy Apple, and it
yeah.
all just pieces together, and it's just mind-boggling.
Exactly. I agree. So let's go back to the Nike. So with Nike, right, it needs to fall how what by half? You say?
More than half, I think it's
Okay.
probably
So what if I'm an investor and I can't wait for it to fall? Like I want to own Nike. Like what do I do? Like do I just like because a lot of people they say when I make a post right and I say the stock's overpriced, a lot of people said you want it at 50% discount. And I'm like, yeah, it has to fall by 50. So I think a lot of people can't wait because they think they're
yeah,
gonna miss out kind of thing. But the thing is, the market overreacts on the upside and the downside. You want to be the one to buy on the downside. So you just gotta have patience because the stock can fall massively next day, a year from now, 5 years from now. Like for me, I'm perfectly fine waiting 5 years, 10 years for an investment that I like, and I know because I'll reap the rewards if I'm patient enough to buy a good valuation. So, what would you say to people who can't wait to own a particular stock because they have a fear it's going to keep going up and they're going to miss out on gains?
Yeah, that is a good question. I think the main thing you got to look at is look at history, and look at the history of investing in stocks at horrifically high valuations.
Mm.
I think everything when they give the two examples of Cisco and Intel back in 2000. So the 2000 tech bubble was, it probably was the biggest stock market bubble in terms of valuation. I can't remember what 1929 was valuation rise, but anyway, yeah, for certain stocks in the tech bubble which were just massively valued, Intel and Cisco. Cisco was dubbed the first ever $1 trillion company.
Yeah.
All these news stories, Intel, there was like adverts about Intel. It was a cool thing to do to own Intel stock. And anyway, I think the peak of Cisco and Intel, the stock prices haven't reached the peak yet. So they crashed in 2000, and today Cisco and Intel have not passed the all-time highs. And if you bought them all-time highs or close, you'd be still in the red today.
Yeah, 22 years later as well.
Yeah, made nothing, a minus figure. So yeah, valuation is the number one important thing. The quality of a business is obviously important as well, but if the valuation isn't there, don't buy it. Yeah.
It takes a lot of training. It takes a lot of training because a lot of people they fall in love with a company that they want to own it. So, and then they convince themselves like in some way to own the stock, and then they buy a crazy valuation. Like let's say PayPal for example. I made two PayPal posts. The first one I said it's too expensive. I need it around 120. And then a lot of people were saying it's not going to get there. The stock was at 180 back then, and a week ago, 2 weeks, the stock fell to like 130, and I'm like, there we go. The stock is down. So if you want a 10% discount, like with no margin of safety, then you can buy it. But I wouldn't do that. I would want a big discount on PayPal due to the competitiveness of that industry. But yeah, these things can happen. You just got to be patient and wait for the right moment. And the same with Square. I think I made a Square post, right? And I said I like it at $44 or $50. And a lot of people said there's no way it's gonna hit like fall to like the low 100. And look what happened. The stock's at like 120 now, 115 now. So these things do happen. So just be patient. Like every stock that you're looking at will go through some sort of an event where it is severely undervalued, and you gotta be the one to be buying it while everyone's scared.
Yeah, it can be bad news story, be it Activision. It can be earnings. The company might beat earnings, but it might give guidance, which is basically what Facebook did. And Facebook's numbers were they were fantastic numbers, let's be honest. But they said, our growth is probably going to slow a little bit. That's reasonable to say. That's not an unreasonable thing to say. Yet the market overreacts and the price goes down a lot. Similar thing with PayPal. They said their growth was going to slow, I believe. And even now their stock's gone down quite a lot. Still think it's overvalued, but it happens and you've got to take advantage. And that's the thing. And that's why I think if anyone can take anything away is have a watch list. Have a collection of companies you want to own at a certain price. And that's a process that you've done, I've done, we're continuously doing. We're getting rid of companies, adding companies. But if you do that over, say, a 10-year period, you're more than likely going to pick up your companies at a fair price. And that's how you beat the market. You buy great companies at a fair or an amazing price.
Yeah, exactly. That's the way to get good returns. Like you're not going to get good returns like buying it at really high valuations because you're going to struggle to make a profit. So it's all about patience, really, and wait for that moment where there's an event like a market crash or missed earnings or something internal within the company.
Missed earnings and bad sentiment, they are
Yeah,
prime times.
yeah,
Bad sentiment's the best,
yeah.
and some companies get that more than others. Facebook is a company about every couple of years, always something that comes out about Facebook, be it Cambridge Analytica with all the data being leaked,
Mm,
Mark Zuckerberg in Congress getting
mm,
grilled about Libra and stuff. It's all in the news. People, oh, Facebook's the worst. And then
mm,
now it comes out Facebook's not going to grow at 30-40% a year anymore.
mm.
It's always going to happen at some point. Everyone knew that. There's only
Yeah,
so many users Facebook was going to get. It happens. Activision, bad news about bad stuff happening in the company, makes the stock price drop 45% in a 6-month period. They're the times you want to be picking up stocks.
yeah, exactly. That's definitely true. Yeah, it can be scary, but you got to separate everything and just look at the situation and say to yourself, is it really that bad? Will the business be affected long term? And if it's not going to be affected long term, then that's when you buy.
Yeah, and if you buy a good quality enough business, that's something I've realised now is
Hmm.
if you buy a good enough quality business at a fair price,
Hmm.
I can sleep at night.
Yeah.
Like I can really sleep at night, no matter how much the stock might go down. With
Mm,
Alibaba, the business is such a high quality business that
mm,
even if it goes down to $80 per share, I'm
mm,
still not going to lose sleep. Facebook might go below $200.
mm,
I'm going to try and buy more.
mm,
If you buy, that's why I like the combination of the value investing side. It's like I do like a bit of deep value in terms of there's a few companies I'm looking at which are
mm,
looking really, really cheap, like
mm,
Smith and Wesson.
mm.
Smith and Weston, whatever you want to call them, they make guns.
Clencher owns that. He can tell you all about Smith and Wesson.
I'm thinking about buying it. That's a proper deep value pick, but I like the business a lot. It's got enough cash. It's got enough current assets to pay all of its liabilities.
Mm.
Way, but yeah, no, it's a solid business. I'm waiting to buy it at $16.70 because that'll give me a 12% return based on what I think the financials will be. And I use really conservative financials. I use free cash flow figure of 80 million just for 3 years straight, not increasing at all.
Mm.
And the discount rate, I did 12% just to see what it'd be, $16.70. So if I can buy it at that, I'm going to load up on it. So yeah, the financials are amazing. It's pretty wild. I had a really good year last year from what I saw. Probably an anomaly, COVID year. Americans going crazy buying guns. Great. But yeah, we've got enough current assets to pay all the liabilities off. And they're buying back shares. So yeah.
I got a question. So, what's the difference between something like a Baba and Facebook going down 50% or something or whatever, than something like, I don't know, like a Palantir or Tattoo Chef? So, what's the difference? I mean, like, what's the benefits can you get?
I think the main difference is Palantir. What was the other one you said?
Tattoo Chef. So what's the difference? Because they might say
Palantir,
you're a bag holder or something because you're 50% down on like Facebook and Alibaba. So what's the difference between being down on a high quality company like Baba and Facebook or Palantir and Tattoo Chef?
the difference is when you own a Baba and a Facebook, you are owning a high quality business and businesses which are very profitable, low amounts of debt, and the proven business models. And the difference with Palantir, for example, it's a business model which is very new. The company itself is in an industry which is very, very new. It's only, I don't know what the financials are with it. I know they're issuing a lot of shares. The difference is if you're 50% down with Palantir, you could lose another 80% because there's no cap. proper cash flow. There's no proper earnings. There's
Mm.
potential for earnings, but there's no. You know what I'm saying? The
Yeah.
earnings you're going to get in the future, and it's uncertain what that's going to be. We don't know what the profit margin of Palantir is going to be. Let the
Yeah.
business become Palantir. Let it become profitable, cash flow positive. Yeah, that's the way I look at it. When you own a Facebook and a Alibaba, when it goes down so much, you're confident that the business is, going to continue growing, going to be profitable. You are a part owner of the business. I'd rather be a part owner of Alibaba and Facebook than a Palantir, unproven.
And also with like your Facebook and Alibaba, they're gonna buy back a ton of shares when their stock has plummeted. So that's more ownership for you, and that's what you want, really.
Yeah, excites me about Facebook. Facebook produces so much cash. If it stays at a low valuation for long enough, who knows where the stock price will go? We don't really care. It's over decades we want the stock price to do, and it will do well. If earnings go up, then stock prices, the price of a stock generally follows what its earnings do.
Yeah.
So if it stays at a good valuation for a year or so, we could see at least 5% of the shares bought back, the market cap bought back, and for us investors, that's fantastic.
Yeah.
That is really, really good at low valuations.
Definitely.
If they can buy, say, 40 billion shares at this price, winner.
Yeah.
So
Yeah.
it doesn't even have to be that much. It can be less if they're using the cash for other stuff. But if they've got the cash, and we can do our for effectively getting a high return buying back those shares. So it's like a dividend, but the yield on the dividend is really good. But it's like a buyback dividend, if that makes sense.
Yeah.
It gives us as an investor a bigger piece of the pie, and that's how we get rewarded. So
Yeah. I completely agree with that. And I expect like Baba and Facebook to actually buy back a lot of shares. And also, when investors look at these companies at such low valuation, they'll think the company's grown at this amount, but it's at this price. So they're going to bid it up, and that's where you're going to ride the wave and get a lot of good profits out of it. But if it's something like Tattoo Chef or Palantir or DraftKings, they look at it like, what's there to go off? Like, they're losing money, they're diluting the holders, and they don't have free cash flow. So not much you can go off, really.
You can't go off any of it, and you don't know what the margins are going to be either.
Yeah.
For me, they're just uninvestable businesses. If a business doesn't make a profit, if it doesn't make free cash flow, for me, it's uninvestable.
Yeah.
That's just simple.
What about if someone said you need to do more research? Then
yeah, my research for them kind of businesses ends when I don't see profit and free cash flow.
yeah.
Because when I'm buying a stock, I'm buying a part ownership in the business. However small that ownership is, there might be 1 billion shares out there. There might be 2 shares. There might be 1 share. The way I look at it is, I'm buying a very small ownership in that business.
Yeah.
And if he was going to buy a business down the road, if Bob down the road's got a car garage, what are you going to ask him if you're going to invest in his little business? Oh, Wes, you're going to come invest in my little business. What's the first thing you're going to ask me?
How much money you make?
Exactly. So why don't people do it with stocks? And that might just seem like common sense, but people just see stonks to the moon, crypto to the moon, whatever. People get it in their heads, and it becomes more like a casino than actually investing into a business. Yeah, look at the numbers. So yeah,
I completely agree with you. So does anyone have any questions regarding anything we've spoken today or anything in general? Let's see.
Yeah, I can't see any questions on the YouTube. Yeah, any questions? I think someone was asking about Google. Thoughts on Google?
Yeah, thoughts on Google. Have you looked at Google?
Yeah, so Google's on my list. it's on the list of companies I want to own.
Yeah.
I do like the business quite a lot. Personally, I'd want to buy it around $2,000 per share.
Yeah. What's the share price now?
It fluctuates. I've got a lot done it. Last time I saw it was like 2,700. So
Yeah.
I don't know what drop that would be, but yeah, it's around $2,000 per share, I think.
Yeah.
It's another one. It's Alphabet, Google, high quality business, not much debt, if any. It's got some really good assets with YouTube and Google.
It's at 2,700 currently.
2,700.
Yeah.
Yeah. It's a high quality business. There's no doubt about that, and that's why it's on my list. Just want to buy it at a lower price, a more attractive valuation.
Yeah.
And the other thing is with Google, and you Google your Apples and stuff, unless really bad earnings come out, it's going to take a crash / correction to buy them. I was going to buy Google at 1,200 back in April 2020, and I'm so gutted I didn't.
Oh no!
What was I doing? But, yeah, absolutely gutted. But yeah, no, I'll own it someday. I'll own it someday. So
yeah, I think when I looked at Google, I had them around the same price as well, around 2,200, around that mark. It's a good company, so just gotta wait patiently, really.
yeah,
I know some people are currently buying it, but I think right now it's around fair value. But I want that little bit of security, just in case.
Yeah, well, yeah, you want that security, and it protects you. And yeah, we all know if, say, for whatever reason, if the market did have a downturn, Google's one of the biggest names in the S&P 500. It will drag the market down with it. So, but yeah, it depends what your goals are, what your return rates are. If you want a return of 6-7%, it's probably a buy.
Yeah.
But 6-7% isn't going to get me to my investment goals. So it needs to be 10% plus.
Yeah.
And the reason why 10% is my minimum, I know your minimum is 15. My minimum is 10% is because the 100-year average of the S&P rounded up is 10% each year. If I can get a return, most of the stocks I'm looking at are actually better than 10%. So we've spoken about Walgreens. I think that at current rates is about 14-15%. Facebook, Meta, way higher than 10%, and Alibaba a lot higher as well.
I think around 20 is for Alibaba,
20, yeah. So you're talking decent returns for quite a lot of stuff. I'm looking, even Rio Tinto at current prices, probably about 10%. So yeah.
Is your price target for Google post stock split? So before the stock split, I'm guessing. So the stock price, 2,200. So anyone got a calculator?
Was it divided by 20, whatever that is?
Yeah, divided by 20.
100?
Yeah. 100. Yeah, so it'd be 100 a share that we want to own it when it stock splits. And I think it's going to have a stock split around one something. I'm not sure, to be honest.
Yeah, I don't know when it's going to take place, but it'll be whenever it'll be. The thing is, the actual share price, don't really care too much. So when it happens, it is what it is. Until it happens, we'll talk about the share price being what it is now, and then when this, let's say we do another live, what's that? July 22. Yeah, the amount of shares isn't too important really. The only reason Google are doing it is so we can get them Dow Jones.
Oh, really?
Yeah, because the Dow Jones, I don't know why it exists. It's a bit stupid. It's an index which was made up by financial journalists.
Okay.
Yeah, you research it. It's an index which doesn't really mean anything. It's just Google wants to be part of it just to save a part of the Dow Jones. So.
Okay. Okay. Any other questions? Didn't see anything coming yet. Anything else you want to say, Lewis?
No, I think we've covered everything. To be fair,
Yeah.
covered a few good topics. Walgreens, what was it? Commodities,
Yeah.
how to
And
navigate,
macro-politics and stuff like that.
mindset and stuff. So
Yeah.
no, I think that's all pretty good. Get some more topics for next week, and we'll just keep doing this weekly. I
Yeah,
think people
definitely.
seem to
It's been
enjoy
good,
it. So
actually. It's been good. Had fun.
had some good fun. If anyone wants to join and chat about stuff and ask us questions live, go for it, because
Mm.
got the link from my YouTube channel here and the link to Instagram.
Mm.
More than happy to do that as well. 100%.
Okay. So should we wrap this up then?
Nice one. Yeah, let's wrap it up. Nice
Yeah.
one.
Yeah, everyone, thanks for joining us and listening. Hope you enjoyed it. We'll be back next week at 7 p.m. Next week, Monday, 7 p.m., right? Is that correct?
That's
then?
right, mate. Yeah. Thanks everyone for watching. Amazing.
All right then. Thanks. Bye, everyone.